Hi friends, welcome back to my channel. In this video we are going to discussing about mock test for NISM Series-I currency derivatives. First question, which of the following reflects a direct quote in India's forex market? Option A, USD 1 equal to INR 83.20. Option B, INR 1 equal to USD 0.012. Option C, GBP 1 equal to US dollar 1.25. And option D, Euro 1 equal to INR 89. Correct answer is option A, USD 1 equal to INR 83.20. In a direct quote, the domestic currency is variable. In India, rates are quoted as INR per foreign currency unit. Next question. A trader buys USD INR futures at 83.15. On expiry, the rate is 83.65. Profit for $1,000 lot is option A 400, option B 500, option C 600 and option D 650. Correct answer is option B 500. Profit equal to settlement price minus buy price into lot size. Here settlement price is 83.65 minus buy price is 83.15 into 1000 equal to 500 rupees is the profit. Next question. Which of the following market participants use derivatives to offset existing exposures? Option A speculators, option B arbitrageurs, option C hedgers and option D brokers. Correct answer is option C. Hedgers use derivatives to protect against price movements that could adversely affect existing positions. Next question. In a USD INR option, if the spot is 83 rupees and strike is 82.50, then what is the status of a put option? Option A at the money, option B in the money, option C out of the money and option D deep in the money. Correct answer is option C out of the money. For a put option, it is in the money when the strike price is higher than the spot price. In this case, strike equal to 82.50, spot equal to 83. So, strike less than spot. The put option has no intrinsic value, making it OTM. Next question. Which of the following is true for exchange traded currency options in India? Option A American style, option B physically settled, option C European style and option D traded in US dollars. Correct answer is option C European style. Indian exchange traded currency options are European, meaning they can be exercised only on expiry. Next question. What is the final settlement rate for currency futures in India based on? Option A RBI fixing, option B average spot rates, option C FBIL reference rate and option D SEBI approval. Correct answer is option C FBIL reference rate. Next question. Tick size for USD INR futures on Indian exchanges is option A 0.01, option B 0.05, option C 0.10 and option D 0.0025. Correct answer is option D 0.0025. Next question. A trader expects high volatility but is unsure of the direction. Then which strategy is suitable? Option A long straddle, option B short call, option C call put and option D sell futures. Correct answer is option A long straddle. A straddle profits from high volatility regardless of direction by combining a long call and long put at the same strike. Next question. What is the risk for an option buyer? Option A unlimited, option B premium paid, option C strike price and option D spot price. Correct answer is option B premium paid. Next question. If Euro USD equal to 1.10 and USD INR equal to 83, then what is the Euro INR cross rate? Option A 91.30, Option B 90, option C 92.50 and option D 89. Correct answer is option A 91.30. Next question. Which of the following is not a characteristic of exchange traded derivatives? Option A transparent pricing, option B daily margining, option C privately negotiated and option D clearinghouse guarantee. Correct answer is option C privately negotiated. Exchange traded contracts are standardized, not privately negotiated. Next question. A USD INR put has a strike of 83.50 and a premium of 0.20. If spot on expiry is 83, then what's the net gain? Option A 300, option B 500, option C 200 and option D 600. Correct answer is option A 300. Payoff equal to 83.50 minus 83 is 0.50. So net equal to 0.50 minus 0.20, 0.30 into 1000 equal to 300 is the net gain. Next question. What does the basis represent in futures? Option A strike minus spot, option B spot minus futures, option C futures minus spot and option D premium minus discount. Correct answer is option C. Basis equal to futures price minus spot price. Next question. Which derivative allows zero upfront cost and bilateral negotiation? Option A option, option B forward, option C future and option D swap. Correct answer is option B forward. Next question. A covered call involves option A buying call and holding cash, option B selling call while holding the asset, option C selling put and buying call, option D buying futures and call together. Correct answer is option B selling call while holding the asset. A covered call is a conservative strategy for generating income on held assets. Next question. Who regulates participation of resident individuals in currency derivatives? Option A SEBI, option B NSE, option B RBI and option D IRDA. Correct answer is option C RBI. It governs forex related participation including residents and non-residents. Next question. Theoretical futures price is based on option A arbitrage parity, option B cost of carry model, option C supply and demand and option D FBIL average. Correct answer is option B cost of carry model. Next question. What is the margin system in currency futures? Option A initial margin only, option B daily mark to market, option C both A and B and option D premium based margin. Correct answer is option C both A and B. Currency futures require both initial margin and are mark to market daily. Next question. A short straddle earns maximum profit when option A volatility spikes, option B price moves sharply, option C price stays near strike, option D spot is far from strike. Correct answer is option C price stays near strike. Short straddle profits from low volatility. Next question. What is the nature of loss for a short futures position? Option A limited, option B capped at initial margin, option C unlimited and option D 0. Correct answer is option C unlimited. Like long futures, short futures carry unlimited loss potential if price rises. Next question. If you expect INR to appreciate, which of the following strategy is correct? Option A buy USD call, option B sell USD futures, option C buy USD futures and option D long strangle. Correct answer is option B sell USD futures. As INR appreciates, USD weakens, so sell USD futures to profit. Next question. What is open interest in futures? Option A, total number of trades. Option B, number of outstanding positions. Option C, total turnover. And option D, broker margin. Correct answer is option B, number of outstanding positions. Open interest is the total number of active contracts not yet closed or settled. Next question. Who ensures settlement of currency futures? Option A, NSE. Option B, SEBI. Option C, RBI. And option D, Clearing Corporation. Correct answer is option D. Clearing Corporation act as central counterparty for trade settlement. Next question. Which of the following is not a currency derivative traded on Indian exchanges? Option A, USD INR. Option B, GBP INR. Option C, Euro INR. And option D, AUD INR. Correct answer is option D, AUD INR. Next question. What is the margin type collected upfront in options trading? Option A, initial margin. Option B, exposure margin. Option C, premium margin. And option D, delivery margin. Correct answer is option C, premium margin. Option buyers pay the premium upfront. Sellers provide margins. Next question. A trader buys a USD INR futures at 83.50 and the settlement happens at 83.15. Then what is the loss? Option A 350, option B 250, option C 300 and option D 150. Correct answer is option A 350. Loss equal to buy price minus settlement price into lot size. So 83.50 minus 83.15 into 1000 equal to 350 is the loss. Next question. A call option is said to be at the money when option A, strike greater than spot. Option B, strike less than spot. Option C, spot equal to strike. And option D, spot equal to premium. Correct answer is spot equal to strike. So correct answer is option C. An option is at the money when spot equals strike price. Next question. Which option strategy benefits most from high volatility? Option A, short straddle. Option B, long straddle. Option C, covered call. And option D, bear put spread. Correct answer is option B, long straddle. Next question. A buyer of a USD INR call option has option A, right to sell USD. Option B, obligation to buy USD. Option C, right to buy USD. And option D, obligation to sell USD. Correct answer is option B, obligation to buy USD. A call option gives the right to buy the underlying asset at a predetermined strike price. Next question. Which participant ensures that the settlement of all currency derivatives happens without default? Option A, trading member. Option B, SEBI. Option C, Clearing Corporation. And option D, RBI. Correct answer is option C, Clearing Corporation acts as a counterparty to all trades, then eliminating counterparty risk. Next question. What does the term notional value of a futures contract refer to? Option A, margin amount. Option B, premium value. Option C, contract size into futures price. And option D, daily settlement amount. Correct answer is option C, contract size into futures price. Next question. Which of these reflects a bearish strategy in currency options? Option A, long call. Option B, covered call. Option C, long put. And option D, long straddle. Correct answer is option C, long put. A put option profits when the underlying falls, making it a bearish strategy. Next question. When a trader simultaneously buys a call and sells a put at the same strike, It is known as option A covered call, option B synthetic long position, option C bull call spread, and option D calendar spread. Correct answer is option B. A synthetic long mimics futures using options. Long call plus short put. Next question. The reference rate published by FBIL is primarily used for option A pricing insurance products, option B daily bank lending, option C final settlement of currency futures, and option D taxation of foreign dividends. Correct answer is option C final settlement of currency futures. Next question. What is the margin called that covers the potential daily loss due to market movement? Option A maintenance margin, option B initial margin, option C exposure margin, and option D variation margin. Correct answer is option D variation margin. Next question. A short call position results in option A limited loss, option B unlimited loss potential, option C fixed return, and option D zero profit. Correct answer is option B. Short calls have unlimited risk if the price of the underlying rises sharply. Next question. Which among the following is not a permitted participant in the Indian currency derivative segment? Option A corporates, option B NRIs, option C foreign tourists, and option D resident individuals. Correct answer is option C foreign tourist. They cannot access Indian currency derivatives market. Next question. An option has a delta of 0.75. This means option A for 1 rupee change in spot, option premium changes 0.75. Option B strike is 75% of spot. Option C 75% of contracts are ITM. And option D premium will drop by 75% on expiry. Correct answer is option A. Delta is the rate of change in option price with respect to spot price. Next question. Which of the following positions gives the maximum upside? Option A long call, option B long put, option C short call, and option D short straddle. Correct answer is option A long call. Next question. The expiry date of currency futures in India is generally option A last business day of the month, option B last Thursday of the month, option C third Monday of the month, and option D second Friday of the month. Correct answer is option B last Thursday of the month. Next question. What happens if the expiry date of a currency derivative is a holiday? Option A postponed to next working day, option B moved to previous working day, option C expired as per schedule, and option D cancelled automatically. Correct answer is option B. If expiry falls on a holiday, it is advanced to the previous working day. Next question. What is the maximum profit on a short strangle? Option A unlimited, option B total premium received, option C difference in the strike prices, and option D 0. Correct answer is option B total premium received. Next question. Fair value of a future with the 3-month tenor is computed using option A interest rate parity, option B moving average model, option C option Greeks, and option D linear regression. Correct answer is option A. Future prices are computed using interest rate differentials, also called interest rate parity. Next question. If spot equal to 83, INR interest rate equal to 6%, USD interest rate equal to 3%, time equal to 0.25 years, then what is the futures price? Correct answer is option A 83.63. Next question. What is the primary risk mitigated by hedging with currency futures? Option A counterparty risk, option B regulatory risk, option C exchange rate risk, and option D liquidity risk. Correct answer is option C exchange rate risk. Hedgers use currency futures to protect against exchange rate fluctuations. Next question. Who determines the contract specifications for exchange traded currency derivatives? Option A RBI, option B Clearing Corporation, option C Stock Exchanges, and option D SEBI. Correct answer is option C Stock Exchanges. Next question. An exporter has a USD receivable after 2 months. Which strategy is appropriate? Option A. Buy USD INR futures. Option B. Sell USD INR futures. Option C. Buy call option on INR. And option D. Sell put option on USD. Correct answer is option B. Exporters hedge by selling US dollars futures to lock the INR value of their future inflow. Next question. Which of the following statements about forwards is correct? Option A. Traded on exchange. Option B. Standardized contract terms. Option C. Customizable. And option D. Margining is mandatory. Correct answer is option C. Customizable. Forwards are OTC, customizable, and privately negotiated between the two parties. Next question. A naked call refers to option A call without premium, option B selling a call without owning the underlying, option C buying a call and a put together, and option D call on unlisted asset. Correct answer is option B. A naked call is risky as the seller does not hold the asset to deliver if exercised. Next question. A speculator expects USD INR to fall. Which of the following positions should he take? Option A. Buy USD futures. Option B. Sell USD call. Option C. Sell USD futures. And option D. Buy USD put. Correct answer is option C. If expecting USD to fall, one would sell USD futures to profit from the decline. Next question. If USD INR spot equal to 83 rupees and 1 month forward equal to 83.30, the forward premium is option A 0.30, option B 0.25, option C 0.20, and option D 0.15. Correct answer is forward premium equal to forward price minus spot price, that is 83.30 minus 83 equal to 0.30. Next question. Which of the following best defines an option premium? Option A strike price minus spot price, option B cost paid to acquire the option, option C fee charged by the broker, and option D penalty for early exercise. Correct answer is option B cost paid to acquire the option. The premium is the price paid by the buyer to acquire the rights of an option. Next question. The seller of a put option has option A right to buy, option B right to sell, option C obligation to buy, and option D obligation to sell. Correct answer is option C obligation to buy. Next question. If a trader sells a USD INR call with strike 84 rupees and spot ends at 84.5 on expiry, then what is the payoff? Option A 0.50 gain, option B 0.50 loss per unit, option C 0, and option D unlimited loss. Correct answer is option B 0.50 loss per unit. Next question. What is the primary purpose of using a currency option over a forward? Option A to reduce margin, option B to guarantee profit, option C to retain upside while limiting downside, and option D to avoid taxation. Correct answer is option C to retain upside while limiting downside. Options provide asymmetric payoff, capped loss, unlimited gain. Next question. A trader buys a strangle with strike prices 82.50 put. and 83.50 call. Profit occurs when? Option A, spot is between 82.50 and 83.50. Option B, spot is near 83. Option C, spot goes below 82.50 or above 83.50. And option D, spot equals average of both strikes. Correct answer is option C. A strangle profits only when the price moves outside the strike range. Next question. An exporter holding USD receivables fears INR appreciation. He could option A buy USD futures, option B sell USD futures, option C buy INR put, and option D sell INR futures. Correct answer is option B sell USD futures. To lock in INR value, the exporter sells USD at today's fixed future price. Next question. Which option strategy involves combining long call and short call with different strikes? Option A straddle, option B strangle, option C bull call spread, and option D synthetic short. Correct answer is option C. Bull call spread involves buying a call at lower strike and selling at higher strike. Next question. What does square off mean in futures trading? Option A, increasing position size. Option B, switching to options. Option C, closing open position. And option D, transferring to another trader. Correct answer is option C, closing open position. Next question. Which one is not a valid reason for using derivatives? Option A, hedging. Option B, speculation. Option C, tax evasion. And option D, arbitrage. Correct answer is option C, tax evasion. Next question. What type of risk is not managed using exchange traded currency derivatives? Option A, currency risk. Option B, operational risk. Option C, interest rate parity risk. And option D, volatility risk. Correct answer is option B, operational risk. Next question. An option premium includes intrinsic value plus option A strike rate, option B margin value, option C time value, and option D spot spread. Correct answer is option C time value. Next question. A trader enters a long futures position. Which of the following is true? Option A, trader has unlimited loss but capped gain. Option B, both profit and loss potential are unlimited. And option C, only gain is unlimited. And option D is only loss is unlimited. Correct answer is option B, both profit and loss potentials are unlimited. Futures are linear. Profit or loss is based on the movement of the underlying with no cap. Next question. The underlying for USD INR currency futures is option A dollar, option B spot rate, option C USD 1000 and option D USD INR spot. Correct answer is option D USD INR spot. Futures derive value from the USD INR spot exchange rate. Next question. Which of these would cause INR to depreciate? Option A, FDI inflows. Option B, forex reserves increase. Option C, rising trade deficit. And option D, rising exports. Correct answer is option C, rising trade deficit. A trade deficit increases demand for foreign currency, then weakening the INR. Next question. A client buys USD INR futures at 83 rupees. The next day, the settlement price is 83.20. Then what is the MTM gain? Option A 150, option B 100, option C 200 and option D 250. Correct answer is option C 200. Next question. Which margin is collected to absorb unexpected large losses? Option A initial margin, option B exposure margin, option C premium margin, and option D variation margin. Correct answer is option B exposure margin. Next question. In India, exchange traded currency futures began in which year? Option A 2005, option B 2008, option C 2010, and option D 2012. Correct answer is option B 2008. Next question. Option moneyness that guarantees exercise at current spot is option A ITM, option B ATM, option C deep OTM, and option D deep ITM. Correct answer is option A. In the money options have immediate exercise value. Next question. A straddle position has maximum loss when option A. Market moves widely, option B. Market remains flat, option C. Call becomes ITM, and option D. Put is exercised. Correct answer is option B. Market remains flat. Next question. Which of the following is not an exchange traded instrument? Option A currency future, option B currency option, option C currency forward, and option D index futures. Correct answer is option C currency forward. Next question. A long futures contract becomes profitable when? Option A underlying price falls, option B underlying price rises, option C premium declines, and option D volatility rises. Correct answer is option B underlying price rises. A long futures position benefits from rising prices. Next question. Which derivative contract includes a premium upfront? Option A futures, option B forwards, option C swaps, and option D options. Correct answer is option D options. Only options involve a premium paid by the buyer. Next question. Currency futures in India are available for how many currency pairs? Option A 2, option B 4, option C 6, and option D 5. Correct answer is option B 4. Next question. Which option strategy results in limited profit and limited loss? Option A short straddle, option B bull call spread, option C long call, and option D nagged put. Correct answer is option B bull call spread. Next question. A long put option becomes profitable when? Option A spot price increases, option B spot price remains unchanged, option C spot price falls below strike, and option D volatility decreases. Correct answer is option C spot price falls below strike. Next question. In India, FBIL publishes reference rates for which currencies? Correct answer is option B. Next question. The minimum tick size for Euro INR futures is option A 0.01, option B 0.0025, option C 0.002, and option D 0.25. Correct answer is option A 0.01. Next question. Which of the following is most sensitive to time decay? Option A deep ITM options, option B ATM options, option C deep OTM options, and option D forward contracts. Correct answer is option B ATM options. Next question. An option has a premium of 0.80, intrinsic value of 0.60, then time value is option A 0.20, option B 1.40, option C 0.60, and option D 0.80. Correct answer is option A 0.20. Next question. An investor writes a put option. Which outcome yields maximum profit? Option A spot falls below strike, option B spot equals strike, option C spot rises above strike, and option D spot drops heavily. Correct answer is option C spot rises above strike. Put seller retains the full premium if the option expires unexercised. Next question. Currency options in India are cash settled because delivery is not permitted. Option B. Options cannot be traded. Option C. FBIL does not allow quotes. And option D. Only retail investors use them. Correct answer is option A. Indian currency options are cash settled only because no physical delivery is allowed. Next question. For a USD INR futures contract, the lot size is option A 100 USD, option B 1000 USD, option C 5000 and option D 10,000. Correct answer is option B USD 1000. Next question. The clearing member who also trades and clears on their own account is called option A trading member, option B clearing bank, option C self clearing member and option D custodian. Correct answer is option C self clearing member. Next question. A covered put strategy involves option A buying put and holding cash, option B selling put and holding short futures, option C buying call and shorting asset and option D shorting futures and selling call. Correct answer is option B selling put and holding short futures. A covered put uses a short underlying position to hedge a short put. Next question. The margin call arises when option A profit exceeds premium, option B loss exceeds initial margin, option C expiry occurs and option D option is OTM. Correct answer is option B loss exceeds initial margin. A margin call is triggered when losses reduce margin below required level. Next question. Currency options in India can be traded on option A RBI portal, option B only interbank market, option C BSC NSC and option D NSDL. Correct answer is option C BSC and NSC. Next question. The mark to market value is option A notional value, option B margin deposited, option C profit or loss booked daily and option D clearing house fee. Correct answer is option C profit or loss booked daily. Next question. A trader buys USD INR call with strike 83 rupees and spot closes at 83.50. Then what is the intrinsic value? Option D 0.30, option B 0.50, option C 0.70 and option D 0.20. Correct answer is option B 0.50. Next question. The best strategy to gain from a narrow range movement is option A long triangle, option B long straddle, option C short straddle and option D bull spread. Correct answer is option C short straddle profits when prices stay near strike and options expire worthless. Next question. The Foreign Exchange Management Act FEMA 1999 governs option A derivatives accounting, option B taxation of options, option C forex transactions in India and option D corporate governance. Correct answer is option C forex transactions in India. Next question. Which among the following is considered a capital account transaction? Option A foreign investment in Indian equity, option B NRI opening savings account, option C export of goods and option D import of oil. Correct answer is option A foreign investment in Indian equity. Next question. The taxation on income from derivative trading for an individual is treated as option A long-term capital gains, option B agriculture income, option C business income and option D royalty. Correct answer is option C business income. Next question. TDS is applicable on which of the following? Option A profit from futures trading, option B derivative premium, option C option margin and option D none of the above. Correct answer is option D none of the above. TDS is not applicable on profits from derivatives traded on recognized exchanges. Next question. A client agreement form must be signed before option A, margin is paid, option B, trade is executed, option C, contract note is issued, and option D, KYC is submitted. Correct answer is option B, trade is executed. Client agreement is mandatory before first trade as per the SEBI rules. Next question. Which of the following is not a sales practice guideline under NISM? Option A, risk disclosure. Option B, conflict of interest disclosure. Option C, misrepresentation for commissions. And option D, suitability assessment. Correct answer is option C, misrepresentation of for commissions. Next question. A salesperson suggesting a currency derivative without understanding client profile violates option A, contract law, option B, KYC norms, option C, suitability norms, and option D, risk management rules. Correct answer is option C, suitability norms. The suitability principle ensures products match the client's risk profile. Next question. An investor should not be offered option A, fact sheet, option B, standard KYC, option C, guaranteed return on derivatives, and option D, disclosure statement. Correct answer is option C, guaranteed return on derivatives. Next question. A registered representative must option A, avoid declaring conflicts, option B, skip verifying PAN, option C, be certified under NISM Series-I, option D, trade on behalf of family without permission. Correct answer is option C, be certified under NISM Series-I. Next question. Which one is a best practice for investor protection? Option A, share client passwords. Option B, offer incentives to churn accounts. Option C, maintain transaction records. And option D, encourage unverified strategies. Correct answer is option C, maintain transaction records. Option C, maintain transaction records.